Welcome to the third episode of All Things Crypto, an Elk Finance podcast. I'm Fareed.
And I'm Shiloh, also known as LT Snake Plissken. So keep in mind, we're not financial advisors. This is not financial advice. And if you're looking for financial advice, please look elsewhere and find a licensed advisor in your area.
Our mission in this Elk Finance podcast is to provide resources to people who are interested in crypto.
Yeah, so that resource today is talking about farming in terms of DeFi, as in decentralized finance. So first, you might want to know a little bit about liquidity pools. And we talked about that in our last episode. So I'd welcome you to go back and check that out if you don't really know a lot about liquidity pools, because we're going to be referencing that here and there. So equally important is if we get something wrong, let us know, right? We want your feedback. We're here to learn, share ideas. And we want you to share that feedback on our Telegram.
I'm always right.
He's never wrong. But in case we are, share that feedback with us at t.me/elk_finance. That's going to be linked in the description as well, and is a link directly to our Telegram. And without further ado, let's get started.
Yeah, I'm very excited, actually. This is my favorite topic, because since I was introduced to crypto, I just love this concept, because I'm coming from a really kind of a traditional investment side, looking at shares and stocks and all this stuff. And I didn't know that with just sitting on your bum, you can just make so much money.
Yeah.
So let's just start. The first question is, what is farming?
So what is farming? So farming isn't the traditional, I'm going to go plant a crop and harvest it in midsummer. No, farming in terms of decentralized finance is basically staking, meaning, let's go back here, putting up your liquidity, like we talked in the last episode, equal amounts of two tokens in order for people to buy and sell from those pools. Now, I remember last time I talked about when we have those tokens in our pool, we get almost like picture it like a receipt from those pools, and that's what we call LP tokens. Now, these liquidity pool tokens, LP, these tokens represent how much liquidity, meaning two tokens and their amounts, how much is present in a pool for people to buy and sell from. Now that receipt, those LP tokens, now again, we take those LP tokens, that receipt, if you will, and we actually put it into what's called a farm. Now, what a farm does is it's a function of a smart contract. So you put it in there, and what happens is you earn tokens based on how much LP tokens, how many LP tokens you have in the farm proportional to everyone else. Now, a farm will have a certain amount, let's say, per day that it emits, right? So let's say I put into, for ease of math, a farm that has an output of 10 elk a day. And let's say there are 5 people in this farm.
Okay.
Right? So let's say I have 50% of the liquidity. I'm a huge whale in that farm. And the other 5 people make up the other 50%, equivalent to me of LP tokens. So that would mean if the output of that farm is 10 a day total, 10 elk a day total, this means I would get 5 of it because I am providing that much liquidity, and I've taken those liquidity tokens and put them in the farm. If you don't put those liquidity pool tokens in the farm, you don't get anything past the normal fees that you would normally get from just providing liquidity, which are generally smaller, but some projects, they are quite large. But in the example of elk, they're a lot smaller. So it's kind of like almost staking a stake. right? Because you're staking your LP tokens almost. You're putting them up, letting people borrow from them. You're earning interest on that. And then you're taking that receipt, those LP tokens, and you're putting them in another farm that generates tokens, if that makes sense.
You know what? It's really complicated, because when you're looking at it, it's just like, so how does that work? How do you do it?
Yeah. And that's tricky because, so the first thing you have to do, right, is go way back. If you just have two tokens, I have $50 of USDC and $50 worth of ELK. So USDC being a stable coin, ELK is ELK. So let's say you have $50 worth of them both. Not
Okay.
50-50 number-wise. I'm talking in value. Whatever they are at the current market price. Then you take those two tokens and you put them in the pool. And you put them, in this case, in the ELK pool, the liquidity pool. And you have to put them in an equal amount. It'll only let you do it in equal amounts. So you submit, you approve that transaction, it goes through, and you're providing liquidity. Then in your wallet will appear these, what's called, like I said, LP tokens. And in this case, it'd be ELP, ELK liquidity pool tokens. And then you'll see that ELP show up in your wallet if you'd look for it on the relevant explorer. So the explorer being the thing that you can see all the transactions on the blockchain, right? So you can check your wallet, you can note them there. Generally, you don't have to. It's okay. But then you go to the farming page, and then you would look for that specific farm. So if I provided USDC and ELK liquidity, I would actually have to look for the ELK USDC farm, because it's only going to accept those LP tokens, that specific receipt for those two tokens, nothing else.
Okay.
Right? So we have to find that relevant one. And each receipt, each LP token is different. And they're going to be different amounts. And sometimes they're really weird amounts depending on the coin. It doesn't matter what the amount is. What matters is how much it's worth.
Okay.
Right?
Yeah.
So then you're going to take that and you're going to put that in the farming pool. And if you're the only one in the farming pool, well, heck, if you're first one in, you get the whole shebang because you're the only one in there.
I love that, because one time I remember we did that and I was just like, I hope nobody's going to get to the farm because we are just like killing it.
Yeah, it's true. And then like 10 minutes later, it's like it's like down by half.
I was so happy for 10 minutes. That's the only thing counts.
Yeah, so that's kind of how you do it. You put it in the pool, your two tokens in equal amounts, put them in the pool, and then take that receipt, those LP tokens, and you put them in that specific farm.
Oh, okay.
Yeah.
So how do you define the duration of these farmings? How long do they last?
So different places have different kind of metrics for how long farming lasts. For ELK, for example, it lasts 42 days. So each round, if you will, lasts 42 days. So the current farms, as they are, last 42 days. And they're just kind of, that's what they are. There's no changes. That's what we've agreed to. And they last 42 days. So you can farm in that farm for 42 days. Now, after that farming round ends, with ELK, for example, we have a new farming round. So we might have found some new projects to partner with or some new protocols we find interesting. So we might acquire some of, set up some incentive for some of their token and our token. So you can provide liquidity for those and then put those LP tokens in the farm as well.
So can this go forever?
Yeah, well, I mean, theoretically, yes. But there's some really important caveats there. So generally with most projects, including ELK, there's a bunch of tokens that have yet to be released.
Okay.
Right? So in case of ELK, there is, thereabouts, 50% of tokens allocated for farming reasons. 25% for, pure 4 years of farming, and the other 25% is allocated for something called impermanent loss protection, which I brought up before, which we will get into a little bit, but again, merits its own episode. So we have these unreleased tokens. Actually, these unreleased tokens, this 25% of all the unreleased ELK is actually allocated to these farms. So that's what's being, it's not just being minted out of thin air for no reason.
That was my question here, because I don't know, how does that allocation happen? I mean, who's deciding? Oh, 25%. No, just screw it. Let's just do 40%.
Yeah. Yeah, it's right. So what it's doing is it's rewarding early investors
Like us.
like us. Yay!
Billionaires.
They're rewarding us for investing in the project and continuing to provide liquidity. So it's kind of a fair way of rewarding those who are here now, and kind of can make you a tidy profit.
So does this mean that I have to always look for these tokens which they have the farming in an early stage of deployment of those tokens?
Not necessarily. Sometimes, like a lot of the times, like if you look at, I'll bring up Cake as an example on PancakeSwap. Cake works a lot differently than Elk. It's inflationary. There's always more created. So the system is completely different than us with our set supply of 42 million or so. But with Cake, for example, you could stake on their decks. Cake has been out forever, and you can earn APRs of 100% or so, or 180% pretty regularly. You can see those come up for specific pairs. But I mean, there's always a risk of impermanent loss, right?
Mm-hmm.
If one of the tokens in the pool goes up or down, as opposed to the other, then you're going to get more of the token that's worth less. You're still going to get more overall if they go up, or less overall if they go down. But you would take a greater loss, if you held them, if you have them in the pool, than if you had them separately.
That is another thing which I want to just highlight, because guys, this is like the numbers we were talking about, like 100% per year. It's just, these numbers are massive.
Yeah.
In the context of, I don't know, for instance, when you're looking at S&P 500 in last 10 years, the average return has been around 9.2%.
Yeah.
So you're talking about one order of magnitude, two order of magnitude more, depends on what you're buying. So keep that in mind.
Yeah, it's for a traditional investor, it's kind of mind-blowing, right?
It is. I'm just like, when somebody told me that it's 100%, it's just like, why am I not doing this yesterday?
And the funny thing is, going back to unreleased tokens, unreleased tokens isn't the only way that places can support a farm. You can also buy back tokens as a project. You know what? You could even buy anybody's tokens, and you could reward them in a farm. There's no written rule that it has to be your own token. It could be any token. If Elk wanted to, reward holders, and we got really big, and we're at a point where we released all our tokens, projects sometimes do a buyback and then redistribute that to farmers. They'll buy when it's cheap, hold it till it's more expensive, and then announce a promotion to further boost the price. And
yeah, this is a very similar concept to the typical share buybacks, when the companies, they realize that their share is too cheap for what it is, and they start basically buying it. And either, as Charlie said, they're going to burn it, or they're just basically release it later. But I never understood the concept of burning a token, because I always hear people talking about, oh yeah, this is a finite number, and this is the maximum number of tokens is going to be out there. And just like, now you're saying that it burns it. It's just like, what the heck?
Yeah. Because
So what does that mean?
so you picture grabbing tokens physically with your hand and setting them on fire, right?
That's pretty much what I had in my mind. Or just like throwing it into I don't know, into the toilet, and just like flush it, and just like, gone. Thing is not existing anymore.
That's true. Yeah. So, and that's kind of the picture it conjures, right? So basically what burning is, it's really simple. The good news is anyone can burn tokens if they want to. The only thing you've got to do is simply send those tokens to the burn address, which usually starts with OX, has a bunch of zeros on the end, right? So you can find the burn address for anything. Some of them even have the word dead on the end, DEAD, for the last four letters of the address. Very creative. But regardless, the zeros are, really for show. chances are it's just basically a wallet that nobody has access to. That's what it is. Once they're there, it's gone. No one can touch it. It's just vanished because you don't exactly have a seed phrase for the burn wallet, and in order to and that's already been assigned at the genesis of the blockchain.
So
So
if I change my mind, it's just like,
you're done.
oh man,
Yep, it's
yeah.
over. So don't send anything to the burn address if you're not a developer. But some people just want to watch the world burn. So if that's your thing, go for it.
I set fire to my tokens.
Exactly.
Yeah, no, it is. It is really interesting concept. But you know what? It's just like, I'm really amazed by similarities between a traditional
Yeah.
investment and the
Yeah.
contracts and small contracts we have in a crypto world. The other thing, Shiloh, which has been very interesting for me, and people always talk about it, is staking and farming.
Yeah.
And it's a little bit embarrassing, but I don't know what the difference is.
Yeah. So all farming is staking, but not all staking is farming.
Oh,
Oh,
smart.
right. So when you're farming, you are basically staking that receipt. Remember those LP tokens in a farm. So you're staking just means you're almost betting them, right? In the traditional sense, you're lending them and investing. Although with farming itself, there's zero risk as long as it's a reputable project, right? Unless they can run away with your tokens, right? Because the value of your LP changes. So it's the liquidity providing that's the risk. But when you stake it in the farm, I mean, you're already in the liquidity pool. So, you might as well do something with that, right? And make profit. So that's what farming is very specific. It's taking LP tokens and staking them and putting them up in a farm, in a smart contract that rewards you. Now, staking, like I said, is kind of holding and putting anything into a smart contract. So staking, you can have single stake, multi-stake. You can have any type of staking. You've seen, everyone's familiar. A lot of people in DeFi are familiar with what's called vaults. Where you stake a single token. That's where if Elk were to develop one, let's say, you would just stake Elk. Right now, they've got some single staking on polygon.unifarm.co. So for the next 16 days, I think, in this current round at the time of recording, so probably I'll be only a couple days left when this comes out, you can single stake your Elk. So you just have Elk and you just put it up into the smart contract and you get rewarded in other tokens. Actually, you get rewarded in like Elk as well as like 4 or 5 other different tokens. The thing is, the difference here is generally staking isn't as profitable because the only value it provides is for the other investors. It's showing that most people and a great deal of people, or how many people, are holding your token, so they're not selling, and when they're not selling, the price can't go down. So that's a positive, but it doesn't really become useful when you're staking that in a smart contract. Nothing's really happening with that token. There's no utility, unlike farming where you have had to have it in the liquidity pool, so people are utilizing your stacks to make trades and borrowing from, like we talked about in the previous episode. But staking is just kind of like, here you go, there's no risk, not as much utility, so generally not as good of a reward. Does that make sense?
Yeah, it does. But the question is, when you're talking about a return, just trying to put some put that in perspective. On a farming, I don't know, what returns do you get versus staking?
It really depends on the protocol. Generally, single staking assets is generally less rewarding. I mean, they can still be up there. Unifarm, last I checked, was what, 90% still, or 95%, which
Garbage.
yeah, right? Where some of the elk farming pools are 200 and some percent.
Okay.
And the other factor is risk, right?
Yeah, absolutely.
Like you're not exposing yourself to very much risk other than the token itself going up or down, in terms of staking, right?
Yeah.
But farming, you've got to have provided to the liquidity pool, so you're having that risk of one token skyrocketing or one token going much lower than the other.
So you know what the messages are just like depends on what your plans are.
Yeah.
One way or the other works for you. I mean, there's
Yeah.
nothing against I don't know, staking versus farming.
No.
Depends on what you like and what you're holding.
Yeah, I like farming because I'm kind of a nerd and it provides more utility, and I'm always a sucker for utility. And plus with elk, I mean, you're getting impermanent loss protection through a farm, right?
That
So,
is the thing which I love, because the you just take care of your downside risk and you let the upside just take care of itself. It
Yeah.
just like blows my mind that
That's-
I'm not taking any risk here.
yeah, other than the like both tokens going down, right? And yeah, so I guess that brings us to what we were going to talk about next, right?
That's right. And that is about the insurance policies to prevent you from losing money.
So, and that's one of the harsh lessons with crypto is very rarely are there any insurance policies in place to prevent you from losing money.
What? I want to make 150% per year forever.
Yeah, with no downside, please.
No.
Yeah, just like Mark Cuban wants to regulate decentralized finance.
I love Mark.
I'm just kidding if you are listening. Yeah, he got burnt on iron finance, which was rough. So I feel
He
kinda
can
bad for
afford
that.
it.
Oh yeah,
I feel
sure.
bad for him, but he can afford it.
Yeah, so there's not actually usually insurance policies in place to prevent you from losing money from any of these. That's where you got to do your own research. The great thing, again, elk, I know I've mentioned it like every point here, but impermanent loss protection is something we have, which is pretty rad. So we get, if the tokens do differ, you're compensated for what you would have, made, what you didn't make if the tokens, you were just holding them independently. So you get kind of compensated for the difference in elk. So why not be providing liquidity, especially if you're holding both those tokens anyway? So
You know what? That is a very good point, because as you said, there is no insurance policy in investment, but at the end of the day, again, what is the probability of the drop in the prices? And what is the probability of gaining prices, and how much guarantee you get there? And just like it becomes a no-brainer game. Yeah.
yeah.
How do you find trustworthy farms?
Yeah, so trustworthy farms are, you can look for a few things. There's never like a sure thing, right? There's always risk in decentralized finance, right? Not regulated, so people can kind of do whatever. And there's a lot of rugs out there, as in rug pulls where they run off with your tokens and you never see them again. So what we got to do is some of our own research to find those trustworthy farms. Is it brand new? Have you heard of any of the developers? If it's brand new and you haven't heard of anyone, those APRs, those rates that you get back might be really high, but you're taking a huge risk. So you don't know necessarily if that's legit. Even if you've maybe heard of one of the developers, are they actually involved? Are they trustworthy, right? We can look at some of these characteristics, but we can't know for sure. So it's a great thing to do, to reach out to some of the others in crypto, in these DeFi chats, and just ask about it. Have you heard of this? Like, is it legitimate? We're going to look for audits, like we talked about last time, right? Like companies, projects, crypto projects, and DeFi will pay for audits where they look at the code and make sure everything is legitimate. And once they're audited, it's a better chance, it's more security that they're not going to have some backdoor, some loophole that they're going to take all your money. Not a guarantee, again, because audit companies can miss stuff, right? We've seen it in the past.
That's right. Yeah, people out there are very smart. And if there is a hole in a system, they're going to find it.
They're going to take
But you know what? It just reminds me of a typical, again, old school penny stocks. The gains, the swing gains are massive, the swings are wild, but at the end of the day, every smart investor, as Shiloh said, starts kind of doing some research on it, And the other thing is just like you don't really bet whatever you have on one of these cases, you
Right.
know?
Only bet what you can afford to lose. Only invest.
Absolutely.
Yeah.
Yeah, no, these are fascinating, and I really recommend our listeners to follow up on these farms and staking, you know, because these are fantastic opportunity to get a very, very handsome return with taking minimum risk.
Yeah, and especially with elk, right? I mean, but we're, the great thing is if you're helping out a Dex, you believe in them, you believe in a project, whatever that project may be, you're providing liquidity, you're helping users trade, and you're helping the Dex become more popular. And that's the great part about DeFi that I love so much is
Yeah.
everybody coming together like a cooperative, right? And we all are the bank together, right? We all combine and we get our share. There's very low operating cost, right? It's the profit comes back to the investors, and that's the part I really love about DeFi.
That is another really good comment. Yeah, you're right, because this is a kind of a community building exercise with the return. I mean,
Yeah, what's not to
this
love?
is yeah, this is really amazing.
Right. Tricky thing though is if a farm, if their rates are too high, they emit too many, right? Then people could sell, and then it can tank their project. So you got to make sure you look at how much are they emitting, because if it's a lot, if your APR to begin with is like something like 50,000%, 5,000%, that's gonna crash because people are going to invest huge amounts. They're going to get their 5,000% in a day, 550,000%, whatever it is, and they're going to sell. Like they're gonna, right? Because they're going to double, triple, quadruple, their money within that 24 hours that are in the farm or less, and they're going to sell and tank it. So just look, if you see those huge numbers, be skeptical.
So kind of an old school doing things. If it
Yeah.
is too good to be true,
Yeah, it probably is.
yeah, it is.
Yeah.
Okay. That
Yeah.
is another thing, you know, because this is another fantastic thing which we are trying to kind of pass to the listeners, you know, is still common sense rules.
Applies. Yeah.
And you have to just make sure that you are understanding what you're getting into,
Hmm.
and you kind of get a feeling for what makes sense, what doesn't make sense, you know?
Yeah, and look for a big roadmap, right? How long are they? What's their plans after this, right? Because if it's a flash in the pan, one and done thing, your money's at risk. They might be a legitimate project, but they might handle it poorly. So just always be on the lookout for those.
Yeah.
And it's funny who would think that 200% return is totally reasonable, but but it's like yes, that's legitimate. But when you get up there, just be skeptical. But yeah,
Yeah. And you know what? Just again, on a common sense, you have to make sure that you know you understand how much risk you can tolerate, and maybe I don't know. One a strategy would be I don't know, taking your when the returns are good, you can just basically protect yourself with taking your initial money out and just letting the rest of it run.
yep,
So it's really we are just trying to give you some ideas about what we think is right to do, but at the end of the day, you're the one who has to decide
yeah,
what works for you.
absolutely, and that's completely up to you. So yeah, anyway, yeah, we thought it was a pretty great conversation. I
Yeah, it
think.
was.
Yeah,
I really learned a lot, and I think you know what, this subject is still one of my favorite subjects to talk about
yeah,
and
it's
just
great.
try to acquire about.
Yeah, so I think next time we're going to try to tackle impermanent loss, and kind of I keep promising we're going to do that. So we will get there. But I want to thank everyone for joining us, and please throw your feedback our way again at our Telegram, t.me/elk_finance. And you can find me at LT Snake Pliskin. I am an admin in the chat, so if you have feedback, I'll pass that on to Freed as well.
I appreciate guys for being with us for another episode and looking forward to seeing you in the next episode.
All right, see you then. Thanks.